Good afternoon, everyone. So it's the 7th of February, and this article was in the Times and on the BBC today. And we can see that real incomes are being impacted here. So, brief bit of history. There's been massive demand for a limited supply of housing stock in the UK. Excess demand, limited supply, prices go up. Historically, until recently, interest rates on mortgages have been very, very low. And lots of people, when you buy a house, yes, you want to buy the house of your dreams and things like that, but actually you tend to buy a house that you can afford. The measurability of affordability is usually on your take-home pay and how much could I afford comfortably, maybe per month, to buy a home. Now, when the interest rates are lower, it won't surprise you that the repayments on that debt are lower as well. A mortgage is generally 25 years, sometimes longer, sometimes shorter. So it's a huge investment. And actually, if you've got fluctuating interest rates, your repayments can fluctuate a lot. Well, we know that we've had inflation in the UK. We know that the Bank of England has been steadily increasing base rates, which has a ripple effect through the banking system, including lending money to borrowers. Borrowing enough money to buy a house, repayable over 25 to 30 years. If the interest rate goes up a couple of percent, it can significantly increase your repayments. Now, we can see here that the typical mortgage has risen by over £1,650 in a year. Now, that's a lot of extra money that people are paying out that maybe they might not be spending on other things. So if we think that what would we get for £1,650, well, maybe that's a holiday for two adults and a child to Mallorca or something. So you have to think about how much this could impact other sectors as well. So we're going to compare the renters and the owner-occupiers, which is obviously supported by the article. So here's the article. I'm not going to read all of it to you. You can go through and look at certain things. So just pause the video and read the article, really. So owner-occupiers have paid that much extra across the UK. It's quite a big number. We have to break it down by people probably. But this is even more important. A third more than they paid in 2022. So you have to think about how much more people are paying than they were before, and have their wages increased that much? I very much doubt it, which means this is a direct link into YED. Now, we're talking about owner-occupiers up here. If the cost of a mortgage has increased, then maybe less people can afford to buy homes. Where are they going to live? Well, they're either going to live with the bank of mum and dad, hopefully not, or they're going to rent. Again, if there's excess demand for limited supply of rental accommodation, then naturally, according to the theory, prices go up. So we can see that mortgage rates are going up. And here we go. In 2023, renters, people that rent property, have paid an additional £8.2 billion, according to Savills, the estate agent. Okay, so you have to think that this is a lot, and slightly more than those paying for mortgages. So it could be that they can't afford the mortgage. Now the rent's going up, there's no alternative. They've even got less disposable income. Okay, so we have to think about how much disposable income these consumers may have. And, we also need to think about, although fixed rates have eased back recently, well, these are fixed rate mortgages where you maybe agree your interest rate for a couple of years in advance. There are also some current fixed rate people that were on the deal before interest rates went up. Now, even though we can see that these have eased back, they're not easing back to where they were before. So actually, those people that come into the market and suddenly have to remortgage, or it goes automatically onto a higher rate, those will have less disposable income compared to the lower interest rate maybe when they first bought their house. Okay, so we're thinking about this. We can bring in terms like inferior goods, for example. Well, I'm not thinking a home is an inferior good, but maybe I've got less disposable income, so I stop buying my groceries at Waitrose and start going to Lidl's and Aldi's. I wanted a new t-shirt, so I now don't buy one. I delay that purchase to another day. I used to go on 2 holidays and now only go on 1. Or, perish the thought, I only went on 1 before and now I'm going to stay at home and maybe have a couple of days out. Well, in that last scenario, that could be a positive for the local economy in the UK. Maybe because of increased mortgages, people can't afford to go on holiday so much abroad. Therefore, they take 1 day or 2 day breaks, or maybe they go camping. We can look at different sectors that could benefit from this. So it's quite important to think about these things. So into YED, there's the definition of YED. This is a copy of the things that you need to know from the unit. This has been taken out of our mark scheme. So obviously you need to be able to calculate it. So we know that it's demand over income. Yeah, so that change in demand over the change in income equals YED. We need to think about what these are. Well, we've got negatives and positives with YED for inferior and normal goods. And we understand, how those might be elastic and inelastic. So we've covered this in class. We're not going to go through the theory in this video. It's just trying to be contextualize it in today's news. We're thinking about the significance on businesses. Well, significance, as we know, this could be a positive outcome for our camping industry in the UK. People can't afford maybe to go abroad so much because their mortgages have gone up so much, so they choose to go camping. The downside in the holiday industry might be less package holidays abroad. Okay, maybe TUI suddenly see a downturn in their sales, or maybe Ryanair see an upturn in their sales because people are looking for budget holidays, and maybe Keone suddenly see less luxury holidays abroad because people are spending so much more money on their mortgages. So we can think about lots of this type of thing, and I've mentioned lots of threats of substitutes, and I think this fits in perfectly to porters, which we'll briefly skim over in a bit. So in context here, from a YED perspective, we have our mortgage payments here, and we're thinking about higher mortgage payments. Fixed rate mortgages have ended, mortgage affordability, and maybe I need to stop spending money on other things. Okay, maybe the restaurant trade in the UK starts to see a bit of a squeeze on people eating out because they'll maybe eat in more. They want the special treat. We've seen an increase in demand for ready meals from Marks and Spencer's, for example, and they put that down to increased inflation, but people still want to treat at the weekend. The rental market, as we've already discussed, we've seen an increase in rents. Partly that supply-demand crunch is what I described, where we've got limited supply and excess demand. It takes a while to build houses. Watch this space, obviously, because there's an article that came out today about Redrow buying Barratt Homes. That'll make them definitely the biggest house producer in the UK. Think about if that's good for the economy. Maybe they've got economies of scale. They can build houses quicker and cheaper than their competitors. Maybe this helps us build enough housing stock to relieve this supply-demand crunch. Maybe this is not in the best interest of the consumer, and maybe they sort of control the prices a bit more. We'll see what the Monopolies Commission say. So the threat of substitutes, obviously we know it's part of porters. We could talk about other elements of porters. I've put a diagram up there that I've taken from somewhere. And we've got the mortgage versus renting. This is substitutes, mortgages versus renting. From a mortgage company, I'm going to be interested in are less people going to be buying my mortgage products. If I own a property, then maybe I can put my prices of my property up. Okay, mortgage is a product. This gets profits. Okay, shareholders' profits. The money comes from somewhere. That's why the bank pays me interest for the money I leave in the bank, so they can use it for other things. Okay, so we need to think about those things. Okay, the geographical substitutes. Well, my family used to live in Bedford. We liked Bedford. Historic roots in Bedford. As our family grew, we wanted a larger house. We could afford a larger house in a part of town that we didn't want to live in. The part of town that we wanted to live in, we couldn't afford a house. So we actually found a house 30 miles away. And for the price of a 3-bedroomed semi in a nice part of Bedford, we ended up getting a much larger house, which is detached next to a river. It's 30 miles away. So you might see people being more willing to commute. That puts more pressure, obviously, on other housing stock in those areas, but it might be that people can't afford the higher interest rates. Remember, they borrow enough money that they can afford the repayments, not really contextualized around how much the house is in lots of cases. So it might be that people sacrifice proximity to where they want to be, sunny Bedford, compared to let's move to somewhere else, because actually the houses are just as nice area, fantastic area actually, significantly cheaper. It's 30 miles. We still have electricity and train lines, so it's not that far away from civilization. Okay, this is the article that I mentioned about Barrett's. You should read this, it's very interesting. Hope merger. Yeah, we will see that resilience in building houses during tougher times is a good time to merge these two companies. Yeah, so Barrett to buy Bedford, so I got that right the wrong way. However, will this create a monopoly? And if it does, we shall see. So let's consider some of those key terms. So necessity, luxury, inferior, normal, elastic, inelastic, those sorts of things. And we've talked through all of this. You can read the text on your own. Okay, just a quick reminder of the formula. And clearly you would write the formula down first, and then a nice blank formula. Always go to the case study first, and it will give you something. It will make you work for something. This could be a calculation with 2 numbers, and you would therefore then calculate whatever the change in income would be if we were using that sort of information. They give you a gift, they make you work for something, and then you calculate whatever the answer is. Okay, it's so much easier if you just put the formula down, blank formula, go to the case study, come back. It's quicker, it's easier, and if you accidentally mess up your maths, you might pick up 3 marks. Okay, hopefully that was useful. Go and read the Barrett Redrow article, and if I've got time tomorrow, I might write a little bit of a revision lesson for you. Woof woof.